Ho, good morning. It is me, Kenny Polkar, your host of the party, and today is Monday, November 21st, 2022. And look behind me, the sky is brewing. It feels like there's a storm brewing, and that's what it feels like so far in the markets as the markets come under pressure ahead of this holiday shortened week. So what is it that we need to know? What is it that's going on, and what is it that's causing markets to remain anxious? Well, there's more Fed head commentary, right? And that's sending markets on a roller coaster ride, depending on who says what, how they say it, the intonation in the voice, what do they mean, what does the markets think it means. Existing home sales plunge. But the question is, are housing stocks becoming a buy? Investors are snooping around some of those beaten up names looking for value, not only in the housing sector, but in some of the other sectors. Oil breaks $80 a barrel. What will the Saudis do now? And like I said, it's a holiday shortened week, so moves in either direction could be exaggerated, up or down. And what do we have for dinner tonight? Well, it's not really dinner, it's a side dish, but you can make it for breakfast. It's a cornbread casserole. I made it yesterday, it's delish. So stocks rose on Friday, capping off a very chaotic week as the data, the commentary, and the action continues to cause investors and traders and algorithms to question what's next. The Dow adding 200 points, the S&P up 18, the Nasdaq gained 1, the Russell ahead by 10, and the transports added 95 points. Of the 11 broad sectors in the S&P, all were higher with the exception of communications, the XLC down 0.3%, and energy, XLE, down 0.8%, with utilities being the best performer, up 2%, which tells you something about the investor. Healthcare, XLV, real estate, XLRE, both up better than 1.2%, consumer staples up 1%, and the remaining sectors up less than 1%. Treasury yields were higher, and that suggests that rates are going to continue to move up even though so many continue to push the Fed pause story, or better yet, the Fed pivot story. The 2-year yielding 4.53%, that's up from 4.3. The 5-year yielding 4%, up from 3.9, and the 10-year yielding 3.8, up from 3.59%. Thursday, we got the St. Louis Fed President Jimmy Bullard, right, telling us that the terminal rate, in his opinion, could be anywhere between 5 and 7%. Right? So do you see what he just did there? He now put that higher terminal rate into the public conversation. He didn't say it was going there, but he did say it could go there. And that's just enough to make it clear that rates have a ways to go. And that caused some initial anxiousness in the market until, of course, he qualified it by saying that the current outlook calls for a terminal rate of 5% to 5.25%, something that the market had already expected. And not to be outdone, Minneapolis's Neely Kashkari said that this rate hike should continue until there's certainty that inflation has stopped climbing. And as of now, that is not happening. So that's more upward pressure on rates. And then on Friday, we get Boston Fed President Susan Collins, right? She expressed confidence that the Fed could tame inflation without doing too much damage. That's contrary to what we heard the two guys say the day before. And so the mixed commentary continues as we move into the end of the year. And it appears that investors and algos want to be on the side of Collins and not on the side of Bullard and Kashkari. The slowdown in some of the macro data points and the calming tone of Collins caused the algos to rip stocks higher, and that took the S&P up 6% for the week, right, which is a very nice move. Now look, last week we got a bunch of retail earnings, right, earnings reports, and most were mixed at best, but not mixed enough to suggest that consumers are tiring. Individual names that missed got punished and other ones got rewarded. And that's going to force the Fed to continue to push rates higher. And while all this is known, investors are finding opportunities and value across many of the beaten down sectors. In fact, one of those sectors is housing. And you ask, housing? How could that be? Rates are up and only going higher. Why would housing be a beneficiary right now? And the answer is simple, is that stocks are not trading on the current news, right? They trade on future news. Remember, stocks are a discounting mechanism, and the recent action in housing stock suggests that some investors are betting on a turnaround, and that the turnaround is going to cause the Fed to slow the pace of increases and then pause and then pivot. To which I would say, okay, but define that timeline, because that's the question. Is it 6 months? Is it 1 year? Is it 2 years? That's a very, very important question to have to answer. XHB, the housing stock ETF, is up 15% since the October lows, but you have to recognize that it's still down 31% year to date. You see, it was down more than 45% going into October, and so the destruction in value is now causing some to dip their toes in the water, asking themselves, can it get any worse? Well, of course it can get worse, but it can also get better, and that's the conundrum. Home prices are expected to continue to decline next year as rates continue to climb. New home sales, existing home sales, housing starts, and mortgage apps are all in decline. And this downbeat outlook has made housing stocks one of the worst performers this year. Toll Brothers down 39%, KB Homes down 30%, LGIH down 39%, Lennar down 23%, DR Horton down 20%. But some investors believe that the worst is over and that there is long-term opportunity in this sector. Well, of course there is at some point. You just have to decide how long you are willing to wait. The bet in the end is that the Fed will stop raising rates, and that will be good for housing stocks. It's also going to be good for some other sectors. You see, investors are once again also dipping their toes into disruptive technology, right? The Cathie Woods' ARK Fund. That ETF, which was down more than 70% year to date coming into October, has rallied by 15% on the idea that the Fed's going to choke, right? Nearly every name in that ETF is down better than 50%. So if you believe the story of a Fed pause, then you can expect that money's going to be drawn to those sectors that have gotten absolutely slaughtered this year. And some of those other areas that are seeing renewed buy interest going in and setting themselves up for 2023. Cybersecurity, artificial intelligence, semiconductors, all sectors that are down 30%. Communications, right? They got absolutely clobbered this year. And if you don't believe that, if you don't believe that the Fed's going to pivot, then you got to put your money in the old tried and true sectors that we've been talking about, that are large, mega cap, multinational names that offer stability, good dividends, and those sectors include all the stuff that people need, right? We talk about it: energy, consumer staples, utilities, healthcare, and financials are all places where you're going to find you're going to be able to hide from the storm. Oil came under tremendous pressure last week as the China demand destruction story took new flight. Supply issues were put to bed and global recession is knocking on our door. West Texas is now down 15% since the beginning of the November highs of 91. Much of the supply concern has proven to be a non-issue, right? Russia, which is coming off the market, is going to sell their oil to India, and then the Europeans are just going to buy the oil from India. So it's Indian oil, not Russian oil, to help solve that problem. All while the Saudis announced production cuts. But I suspect that if oil continues to decline, the Saudis, OPEC, are going to announce additional supply cuts to try and prop up the price. This morning, oil is trading down 40 cents at about $79.80 a barrel, getting very close to Joey's buy range of $72 a barrel to refill the SPR. The dollar index is up 90 cents at 107.81 after testing and bouncing off the trendline support last week on the 15th, right? The dollar remains in the 105.50, that's support, 109.20 trading range, right? So support and resistance. Gold has backed off a bit. The stronger dollar and the idea that inflationary pressures were receding is causing that pullback. Gold now remains in the 1740, 1830 trading range, right? This morning trading around 1760. Eco data today includes the Chicago Fed survey. Expectations are for a slight decline. Nothing to write home about, just a slight decline. Later in the week, look for durable goods, Richmond Fed survey, capital goods ordered, capital goods shipped are all macro data points you should pay attention to. Wednesday's also going to bring us the U.S. S&P Manufacturing and Services PMIs. Manufacturing is expected to be right on the neutral line at 50, while services is expected to remain in the contractionary territory at 48, right? So that brings us down on the services side. And remember, the U.S. economy is 75% services. Markets are closed on Thursday and only trade for half a day on Friday. I suspect that we're going to see this rally going into the end of the week, as we usually do. But so much can happen. This morning, U.S. futures were down, right? They were down. Dow was down 80, S&P's down 20, NASDAQ down 85, the Russell down 9. Look for more retail earnings this week from Nordstrom's, dollar stores, and Dick's Sporting Goods. Now, I must say, I am getting bombarded with flyers and internet offerings announcing all kinds of sales on clothing, kitchen stuff, TVs, and other electronics, furniture, both indoor and outdoor, etc. Right? The funny part is that the sale prices are marked down 30%. But what they failed to disclose to you is that the prices are up more than 60%. So is it really a sale, right? Prices are up 60. Okay, they're going to take 30 off. They're still up 30. Come on, who's kidding who? European stocks are down anywhere between 0.5% and 1%. German wholesale inflation, their PPI number is well below expectations, coming in at negative 4.2%, smashing, right? Versus the consensus estimate of up 0.9%, leaving annual price increases up only 34.5% versus the expected 41%. And that should be being viewed as positive, but at the moment, nobody seems to care. The S&P closed on Friday night at 3965, up 18 points, leaving us solidly in the 3793, 4073 trading range, right? Remember, this is a holiday shortened week. Moves can be exaggerated as many are away from their desks. Portfolio managers have placed buy orders below current levels while they place sell orders above current levels to take advantage of any outsized swing that may result this week while they are away celebrating the holiday. Be careful to not make any dramatic moves this week during times of lower participation. But if you have to put money to work and you're away on vacation, pick levels that you're comfortable with, right? Just like the big asset management firms do, and place your orders. If the market trades down to where you want to buy them, then guess what? You're going to buy them. Conversely, if it's going to do the same on the sell side, right? If you're looking to trim a little bit at higher prices, nothing guarantees it's going to happen. But if it does while you're away, then you won't have missed it, right? Capiche? So if you put orders to sell stock up higher and the market trades up there and you make your sale, that's good, right? You weren't around to see it, but that's where you wanted to sell it, and in fact, you sold it. So you want to sit tight, stick to the plan, focus on the end game. Okay, so what are we having for this side dish for Thanksgiving? Or you can even have it for a Sunday morning breakfast. I, in fact, made it yesterday morning for a Sunday morning breakfast because it's nice, it's heavy. You put some, take it right when it comes out of the oven, put butter on it. Oh my God, a cup of coffee, it's delicious. So I got this recipe from a former coworker and a Morning Thoughts reader, right? It's one of his Thanksgiving family favorites, and he wanted to share it with me so I could share it with you, right? So grazie Remo, I appreciate it. Okay, it's very, very simple to make, right? And I made it, like I said, yesterday because I wanted to try it, right? And by yesterday morning, I made it. By Sunday night, it was gone. The whole thing is going to cost you about $12 to make it, if it even costs you that. I use gluten-free cornbread mix just because I have to, and it was delicious. So regular cornbread mix is fine. So for this, you need one box of the cornbread mix, right? So I used one box of the Crustez gluten-free, or you could buy 2 boxes of the Jiffy cornbread. You need 2 14-ounce cans of creamed corn, 1 10-ounce container of sour cream, 1 stick of melted butter, and 3 beaten eggs. You want to preheat the oven at 350 degrees. Now in a large bowl, you want to mix all the ingredients, right? Then put it in a greased 9x12 baking dish, right? Make sure you grease the pan. Bake it for somewhere between 50 and 60 minutes, depending on your oven, until the top begins to take on this nice golden brown color. Remove it, let it just sit for a couple of minutes, and then cut it and enjoy it while it's really hot, just out of the oven, with a cup of coffee, a slab of butter on it. Oh my God, it was so good. But it's hearty, it's very, very filling, which means, you know, the creamed corn makes it really thick and filling, which makes it delicious. So that's why you can either use it as a breakfast dish, you can use it as a side dish on your Thanksgiving table, or even as a side dish on any table at any event. Look, the clouds are building. You see that black one right above my head? It feels like it's about to pour. In any event, take good care.